Hello and welcome to another episode of the SwingTrader Status Update. It's Justin Nielsen here, and we are coming to you live at 5 p.m. as we typically do on the second Tuesday of each month. So today is October 14th, 2025. And man, it's been a time here for for the last few days, helping us kind of go through it and what we've been doing on Swing Trader, what the performance looks like, and how to kind of think of this market in its current state. We've got Mike Webster, our senior market strategist here at IBD. How you doing, Mike?
Pretty good. I just saw that my mouse is about to die, so hopefully I don't
Perfect.
need it. We'll see.
One of those days, right? so, let's see. Let's start with just a little conversation about what has been going on with the market. And look, this is where sometimes it's just not easy, right? We had a very ugly day on Friday, and that led us to basically get out of the market completely. That's based on kind of the recognition that a lot of times what happens after a day like that is there's a lot of back and forth volatility, and it just becomes very difficult to keep your losses small when you've got a very volatile market. So what do? We just kind of step aside. Now we did do some buying here on a lot of upside reversals today, and we'll talk about some of that. But Mike, why don't you go ahead and kind of give us an overview of what this market looks like to you and what precedents you're kind of using as a guide right now?
Sure. So we're going to get into the precedents shortly, and we've got a bunch of them to look at, or potential ones. But without getting into that, let's just talk about what was going on in the market and why we did what we did on Friday. And so we were, up to our eyeballs in stock. We were, fully invested. I think maybe marginally on margin on that day. We added, I think it was Core Weave or something right at
Mhm.
the open, and then when it was moving, it was up like 3 or 4% on the day, but it really, we weren't up that much because we put it on the gap up, but it just was not acting right. But we weren't taking action yet. We were just, it was the first sign that there was a little something going on. Like it really should have moved more than that. And that's just what's, you look at a stock and you see what's normal and natural. And there was a lot of that going on. That was just the one that was kind of sticking out of my memory. And then you got the news. And when you got the news, let's go to the intraday chart.
So I'm going to probably have to. Oh no, yeah,
Yeah,
we've got
yeah.
it.
So you
If
can
anyone
see.
can guess where the news happened, and again, this was just again more of the tariffs. This is China with their curbs on rare earth metals. President Trump was like, "Hey, we've got to do something about this. This is not fair. So we're going to slap you with 100% additional tariff if you don't kind of correct that behavior." And so that's kind of what started this.
Yeah. So this is kind of the, we're the end result of negotiations going on worldwide. And it's the way it is, not good or bad. It's just, like every market has something you have to deal with. It's earnings typically or economic data. And now we're dealing with this war essentially between two countries. And that's fine. We'll deal with it. But you can see that news reaction when that happens. You got to realize the market mechanics now are completely different than they were when Bill O'Neill, the founder of IBD, started trading, or even when we started trading, because now you've got a bunch of algos that will read news, read really text reading algos, and they will act faster than anyone can act. And they just are smart enough to know if it's negative news or positive news and how negative is it. And they have their sell or buy programs. So you don't want to read into that too much with the initial reaction. Then what happens afterwards, this is just my interpretation of it, is you have a bunch of other algos that are just they're just looking at what the intraday action is, and they will just magnify it. If things are going up, they'll just jump on that momentum. Things are going down, they'll jump on that, and so it kind of magnifies things. So you kind of have to wait for the humans to get involved to see what reality is of the market. So we started taking some things off, but we weren't going, completely to cash right away because we wanted to see if you would have a reaction back once the humans got involved, and that didn't happen. So one by one, we just started cutting bait on all of these things and we went to cash because there's a few reasons. One, we can go back to the daily.
Hmm.
It was a Friday, and we were right above the 50-day at that point. And the what would have been normal and natural is on Monday to have a gap down through the 50-day, which would have pushed us to cash anyways, because all of our stocks would have been hitting their sell signals most likely. Now, the market got lucky with some positive news over the weekend. You can't play off a hope and hope that news comes in. So anyone who wasn't selling on Friday, frankly, the reality is, dude, you got lucky, with some positive news on Monday. And that was, I was saying on IBD Live, that was a gift to people that if you had been sitting all weekend going, man, I really should have sold things because this could get really bad, and you didn't, you had your chance yesterday to sell. We didn't add anything yesterday. It was hard to not add, but the reason why we didn't add yesterday and we added today was there were no, from a swing trading standpoint, there were no setups for our style. Our style of swing trading, there's multiple ways of, lots of ways of swing trading. Our way is to, really have a tight exit, 3.5%. Some people swing trade with a much even tighter than that. That's kind of loose in some worlds. But there was nothing that yesterday that we could have bought that a normal and natural intraday movement wouldn't have triggered our exit signal. So it just didn't make sense to buy anything yesterday. Now, today, we had a test of the lows from Friday and a successful test of that, my interpretation of it, because you got close to it. In fact, let's go back to the intraday because this part can probably be seen better. When you gap down this morning, um, it was should have been a magnet to take out those lows because that's where any bear would have wanted to push it through because then the market should have broken wide open because a lot of stops would have been on those lows. And when it firmed up and wouldn't go back and took out the morning high and then wasn't looking back, we said, you know what, this is the time where we need to start putting some things on the list because we could be in the range bound market and we'll want to get some, if we're in range bound, we'll want to have some trades on, probably not get up to our eyeballs in stock unless things are really working. But it was a place to start putting things on if you had a nice exit strategy. And so the first one we went with, I believe, was Walmart. Let's just pull
Right.
up Walmart. Um, and what I liked about Walmart, and I do have a position in it now because I did end up
As do
buying
I. Mhm.
buying everything that we ended up putting on the list, which is typically what I end up doing. So it was strong out of the gate and strong for Walmart with some news going on in it. We don't have time to get into that, but what was really constructive action of holding in there tight. You see right around 105, just little like mini intraday flat base, and just that was a true sign of accumulation. And you should look at intraday charts. Bill O'Neill did. He called me up and discussed 5-minute charts all the time. He was a tape reader. I'm a tape reader. And that's what intraday charts are. They give you an edge. Let's go back to the daily. But what was nice about this is we had a clear exit. If this would have gone down to yesterday's close or even yesterday's low, that was underneath the 50-day, and that would have been a failed breakout, and we would have exited. And it was just, lots of trades don't end up working out. So we were looking for other ones like that that had a nice exit. And we found some upside reversals. Those I prefer over breakouts, but this one, because it has a really kind of a low ATR, it made sense to go with that. So Viking, I bought a position in this after our 30 minutes were up, or actually
I have
probably
a
an hour
position
or
in this
so
one as
because
well.
I was busy with meetings. But what I liked about this is people were probably looking at this to short recently, and
Hmm.
those can be some of your best longs. When the shorts get squeezed, they tend to really kind of pop up. And let's go to like CCL, which had been one of the leading stocks in the group, CCL and RCL. And that was in that weak position underneath your 50-day. And we wouldn't want to put something on like this because we don't like buying underneath the 50-day, but it felt like the entire group was making this move. So we don't have to go through all of the other ones, but this was certainly the strongest. So let's go back to Viking. when you're getting back in the market, you want to have things where you absolutely know where you're wrong. If this were to go back underneath today's low, we would be wrong. Actually, even
Hmm.
before that, you pretty much know you're wrong, but certainly at that low, line in the sand, clear cut, you're out of it. Versus a lot of the heat that was running yesterday, they could have come in 5, 10%, like the true heat that was running, and still not even, yeah, I did end up buying this back. But you know, this one, and I probably bought that one. I bought everything today. Yeah, I really did. I had to do a shotgun because I was in meetings. But all this junk, really, then I'll trade junk, could wiggle and wobble. That was up 6%, and it doesn't even look like a huge day on there. It could have gone down 10% and still been okay. You wouldn't really know that this one is broken until it was around 32 or so. So we couldn't do things like that on SwingTrader. Plus, the ATR is too high. Um, but that's why we were going in today, because we had exits that we could go with. I'm still concerned about the news flow. Obviously, we saw that with what happened late in the day, and we can talk about that in a minute. But we will continue to add things on the list that follow our rules. So, what are those rules? They're above $10, above $75 million volume at our minimum. We'd like to go a lot higher than that for most of them. Above their 50, above their 200-day, with an ATR, average true range, of under 8%. That's our basic, our basic screen, and then we look
The
through and that
universe, if you will.
universe. That'll give you about 500 stocks, give or take. And so we'll pick the ones from there that have good exits on them. And as we see those, we'll be adding, but we will easily go back into cash, and we could sit in cash for a while if there's not something that's setting up right. We are not going to, um, you know, just put on trades just for the sake of putting on trades. We're only going to put on trades if they make sense and there's a really good exit strategy.
Absolutely. Uh, Excuse me. Well, let's take a
Well,
look.
let's go to the intraday chart real quick on that
Okay.
point of late in the day, because this is important. So we saw the break that happened on Friday and how bad that was. Now we've got some more news from President Trump regarding China, and you saw that sell off right away. But look at the magnitude of that versus the other one. It kind of feels like that was the earthquake, and this is the aftershock.
Mhm.
And when those aftershocks get smaller and smaller and smaller, it means that the market is starting to price it in. So you still have the text reading algos that are clearly involved in selling this off, and then everyone's looking around for what's the news, and then you go, okay, well, yeah, that's about what is going to happen. We could go back to the daily. If you don't understand what's going on, President Trump and President Xi are just trying to get the most for their countries. Trump is trying to get the most for the USA, and China's trying to get the most for them. You can't blame them. But we are going to be on the receiving end of this news flow of this negotiation that is done in real time in the public. So don't expect smooth sailing, because it can look really good and then you're going to get some tweet out of the blue. But as those aftershocks get smaller and smaller, you know that they're priced in, just like what we saw from February to April. The market was trying to price in all of the tariffs. And if you listen to most people at the time, we were going to zero because the tariffs were going to kill the economy and everything. But the market has a way of pricing things in. Um, and and it did that then. It'll do it again. Doesn't mean that we always go up, but it will eventually factor in the risk and put a number on it.
And sometimes that takes a while,
Yeah.
right? Especially again, if there are a few volleys back and forth on this negotiation and this positioning, and that's kind of what was going on in March and April, right? Especially as you got it kind of culminated with Liberation Day, and then some adjustments and everything like that. But you kind of have to wait for that evidence that the market started to price that in. And to me, at least, what I start looking for is tighter action. A little bit more equilibrium. When it's all over the place, that means the market just doesn't know how to price it yet. It'll figure it out eventually, but I don't want to. I don't want to be playing while it's figuring it out, because again, it's just so hard to manage your risk at that point. But once it starts getting tighter, and look, it can get tighter, and there can always be like a new news item that throws things. But once you start getting tighter, it's kind of like, okay, this is um, you know this is what the expectation is. And your analysts and everyone is kind of able to kind of model it, put their numbers in. It's not all over the place. And so uh, a lot of people like the volatility. They say, oh well, gosh, more volatile, the more money I can make off of that. But as you know for us, a lot of times managing the risk is so much more important than always gunning to get every last cent. If we can't manage our risk, then a lot of times we're going to take our toys and go home.
That's not cool.
Well, hey, it is what it is. Do you want to take a look at some of
Yeah,
the precedents? So what
yeah.
we'll do here, real quick, is we're going to show. And again, this was a very simple query that Mike came up with, um, to just say, okay, what does that what days look kind of like October 10th. So here's October 10th. We were down 3.56%. And immediately what jumped out to you, Mike, was how December 18th looked, which just so happened to be down 3.56%. Yeah, that's not a typo right there.
Yeah.
And we also want to just not just look at the percentage, but also, okay, what was the ATR in relation to its average ATR? So in this case, we're using a 21-day average ATR. I put the day of week just for fun, just to see how many of these were Fridays. And we had some very simple rules, right? We're looking at the 21 on the day in question, that the 21 was above the 50-day, that the 50-day was above the 200-day, that our high was above the 21-day, at least at the start of the day. But then by the end, the close was below the 21-day. And we also wanted to see, hey, you know, this was a poor close. So in the lower quartile of its closing range. And in order to just kind of narrow things down, we wanted to look in that and see that factor was 3 times as large as the average ATR of the last 21 days. So talk a little bit about these results. And again, this is something that you might want to just pause the video here, kind of jot some of these down to go look at on your own. But we will take a look at some of these all together. I also want to add that day two, this is the columns right in here. We wanted to see what that day looked like, and sometimes it just continued lower. Sometimes you had a little bit of a move higher, 2% higher after the 2018. I think was that the Volmageddon?
Yep.
I think was going on there.
Yep.
We wanted to see, okay, what was the factor for that day versus the average on day two? What was the closing range on day two? And was it an inside day or an outside day? So those were the things that we have in there. So go ahead, Mike. What do you take from this?
Yeah. So one, what I take from this is I love working with you, bud, because I can ask you, I can be like, oh, what about this, and this, and then you can just, yeah, I don't know how you do what you do, but then you can give me the dates, and I can look at them, and it's just a great working relationship of being able to, my shorthand and everything, and so going through all of these, which I was, doing earlier today. There's some bad data in our database on some of the earlier ones, so we're not going to pull them up right now. But I suggest that everyone go through each one of these and study them, because we look to the past to understand what would be normal for the future and the present. It doesn't mean it's going to happen that way, because we don't know what the news flow is going to be, but you
Mhm.
have to use something as a gauge to know what is normal and what you should expect. So we're going to look at these from 1995 to current here in a second, but really go through the each one of these, go to the day in question, then go to the next day, and maybe out a week, and then go out 3 or 4 months from then to get a sense, did the character change on that day in question or not? And I think you'll find that it did change. And then your job is to figure out, did it get stronger or weaker, and what can we expect? So why don't we go with the July 19th and start there.
Okay. Uh, so this is July 19th,
95.
95, right?
Yeah, and for those listening, we always do this on the Nasdaq. If just assume it's on the Nasdaq unless we say otherwise.
Hmm. Um, and yeah, this was pretty impressive, actually.
I'm
You
not
were,
seeing it yet.
yeah, it's coming.
Oh, okay.
Yeah, pretty impressive the other day. You threw out that it was on your birthday, and
And
David Hatman Chung was putting down what you were, or picking up
oh,
what you were putting
Joe.
down.
But he reminded me. He texted me on my birthday. It was very nice of him.
Uh-huh.
Okay. So here's this move that looks very similar, right? And you think about it, lots of us have been talking about this might be like 1995. I think our good friend Jim Ropel has probably been talking about that as well. And it's kind of an obvious go-to. So things were getting overheated, and you can see that kind of parabolic type of move that we haven't been seeing in our indices, but in the heat, you've been seeing that with the nuke related uranium,
Hmm.
all those plays, the quantums have been doing this kind of parabolic thing. And you got to remember, back in the 90s, the Nasdaq was a little bit different than the Nasdaq is now. Certainly in the 70s and 80s, it was different. But so you have this extreme move up, then you this crack that was very similar to last Friday, just something out of the ordinary. Let's just go to the next day.
Oh, okay.
And so here, kind of similar to what we had on Monday, you have this gap up inside day. And, it's just like, wow, you were expecting this horrible stuff and it didn't happen. So let's just go out to save on time. Just go out to the end of this year. Just put a 12 instead of a 7. Okay, and if you could point to that. So notice how now the character changed after that. This is a good example of, believe it or not, this is one of the good ones of where it actually just goes straight up to new highs and then has some trouble. So you want to file that away in the back of your mind that this is a good example. So you don't want to get too bearish, because if you were, then you would have missed out on that and probably eventually bought it top tick. So that's another reason why we were being flexible today in getting back in the market after being in cash all day yesterday. So let's go to 3/8/1996. Okay, and that one just doesn't have that same feel in that this one was coming more just out of a base, but still we want to look at it because it met the criteria that we asked for. So let's just go to the very next day. And okay, so again, it's kind of technically an inside day, in up a fair amount. Let's go out to the end of June, or just go put a 7 in there and 7-11. Okay, and what was the 3/8? Can you point to 3/8? Okay. So again, this one ends up going higher. It is not the perfect precedent because the setup was a bit different, but still, it gives you that sense like you don't want to get overly bearish, but you do want to realize, that they can fall apart. But this one didn't right away. And let's go
Hmm.
to the next one. We're going to jump forward a decade. 9/9/2016. And you're weird when you do those dates. Um, so again, not exactly the perfect setup because with ours, we had been running for a long period of time, and this was a kind of a shorter move out of there. But this break that was very reminiscent of last Friday. That oversized break, closing at your lows, was a little bit different about this one. Is it went down to your 50-day. Let's go out one day. Okay, so what was unique about this one versus ours, so it's not a perfect precedent, and that's why we're going through this, so you know what to look, which ones to kind of gravitate towards and which ones not to. This one did something completely different than what we had yesterday. This had a chance to truly test the lows, because it undercut them and then was able to power back up. That would have been ideal. That's what I was hoping for Monday, and it didn't happen because we got the positive news over the weekend. The positive news was actually a negative for the market because we didn't get to see what the market was really going to do. Of course, there was all the turmoil on late Friday and Saturday with all the crypto area, and that brought a lot of fear back into the market. And frankly, it would have been good to not have that news to see where our market opened up and if we could have done something like this naturally. Let's go out to the end of that year. And if you could point to the day in question. So again, you go back up to new highs. So if you don't start getting back some exposure, you got to ask yourself, where are you going to get it? Now, you wouldn't have wanted to get too heavy because look at what ended up happening. That wasn't fun. I'm sure we both remember that one, right, Justin? That's
Yes. Yeah.
yeah,
Yeah.
that time. That was the
No fun.
election and all.
Mm.
Let's go to the next one, 321.17. Okay, so this looks quite a bit more like what we've been dealing with because you've been running for a long period of time. You did hold above your 50-day, but this just break out of the blue, really significant. Let's go out one day. And again, kind of like our last one, it did undercut the prior day. So not a great example for us to use as a precedent because of that different, it is a material difference whether you undercut that or not. So let's go out to the end of June, maybe. Okay, and you can see that it kind of got back to its character, believe it or not. Like it kind of brushed it off, but you were just chopping along sideways for several weeks before you went back up. And you can leave it on here and just point to 517 of 17 because that was another day where that happened. And then the next day, again, an undercut. So again, not a perfect precedent. But then you end up moving. Let's go out to like the end of that year. Just put a 12, yeah. And it just kind of settled back down. That was a weird year. Remember, like it was just
Yeah.
so tight. And those days, each time that happened, it was like, oh wow, okay, now we're in for the big one, and it just firmed up. That might be what happens now. Hopefully, let's go out
And
to
just notably, the S&P 500 at this time, the largest drawdown
4%, maybe.
was
Oh
3.4%.
wow,
Yeah.
wow,
So yeah, it was nothing. So
three point
basically,
four.
and
Wow.
look, it was tough because for swing trading, I'll be honest, I did not do well. You look at the weekly chart and you're like, how could you not just kill it that year? And it was, again, all of those times I was waiting for the next shoe to drop, and it would just come right back. So I was doing a lot of buying buying at the highs and selling at the lows, and that just doesn't work quite so well for uh, making your portfolio grow.
I think a lot of us, myself included, were doing the same thing. It was a lot. It just depends on your style. Position
Mhm.
traders, they're like, "What are you
Oh, it
talking
was
about, man?" Like it's like,
leaderboard killed it.
oh yeah,
Yeah.
it's like it's like going to Disneyland. It's like
Mhm.
good, just buy something and go on vacation. Let's go to 2018. And what was a bit different with this one is that you had already been breaking, and as you were referring to earlier, this was around the VIX and blowing up and everything. So it was specific to that news. But I think it was actually I must have given you the date looks off, but
You know what? I
um,
wonder if maybe my something's off on my days where it
Yeah,
was
because it
taken
should
the
really
day
be the
two.
day
Yeah,
before
yeah, mhm,
the Friday. But
yeah.
anyways, so let's just go back one day because that would have been the the second would have been the day in question. Okay. So with that day, which would have been the, the one we were probably looking at, the expectation is what do you have the next day? So that was more, normal. Let's go out to maybe the end of June just to see how that played out. And you could see that you had this tons of volatility in there. And what's worth noting is that first upside reversal we had after we broke the 50, there you think you're like off to the races and it will never go back down. And then you just undercut one more time and then you have the test of the 200. So this is telling you we could be in for some uh, rough times and really hard. Like, that's really hard to trade in that. I don't care what style you're trading in there, you're going to get chopped up. Maybe a day trader who's really good or something, but I'm not going to do well in that. Let's go to December 18th. This is kind of my favorite one, December 18th of 24. And this one feels a lot like it. And I think we can all remember this day because it was not too long ago. And after that, you should have just really gotten conservative. Now, I got too aggressive too quickly after that. And that's why I'm, trying to just remember that and remember that feeling of, yeah. So your next day, you kind of test that. Let's go out, let's go out a couple weeks. So you get a little upside reversal there. So that is where you would want to be buying some things on there, but just not going hog wild until your low is able to get above your 21-day and stay above it for an extended period of time. And by extended, at least 3 days. And then that's when you can start making money. Now, you still doesn't mean that you're free and clear because they come right back in sometimes, but at least you have more evidence. So again, if I should have been hammering that point in more on these, that when you break, your first sign is you want to get back above. Well, let's go back to the current date. That you want your close back above your 21-day. That's kind of your first thing. Then you want your low above your 21-day and to close above it. So that was looking like it was going, yesterday's close was back above the 21-day, but we didn't get our low above it. So then our next thing that we want is we need our close back above the 21-day first. Then we need our low above the 21-day and to close up on it. Then we need 3 days with our low above the 21-day and closing up. And then ultimately taking out the highs from Friday. Now, taking out the highs from Friday might happen before that, or might not happen for a long time. We don't know. But point back to the December 18th day. So this is kind of my base case. That's what I'm expecting it to be difficult for a period of time. And that period of time is going to be dictated by how the two countries can end up working this out because it seems like that's what everyone's focused on right now. Feels like the Fed is, in its easing mode in various ways, shapes, and forms. It might not be to the as fast as everybody wants, but I think probably at the right speed. So they've got the ship pointed in the right direction. But we've got earnings. We saw that
Mhm.
with some financials today, and we're just at the very beginning of it. That could be a very positive catalyst or very negative, and we'll just have to keep an open mind. Yeah, J.P. Morgan looked rough this morning. It looked like it was really going to break apart, but it firmed back up. I still wouldn't want to buy it there, but at least, yeah, it's not bad. Ending only down 2% on earnings that were clearly disappointing to the market, or it wouldn't have been down.
Mhm. Yeah. Well, let's go ahead and shift gears a little bit here.
Sure.
We'll go back to our, uh, let's see, we'll go back to our slideshow here. And again, here's this one more time for everyone to look at. And again, just realize that sometimes um, The data is back. I think one of the ones that we showed, it didn't look like the high was above the 21-day moving average line, but the high was off on that market surge. Some of the older dates, we've got to go back and fix. But let's talk a little bit about the performance right now. Of course, with this big drop that we had on Friday, and look, we took a hit. We were up there in our exposure. Um, and so now we're back below the 10-day moving average line and 21-day moving average lines of our equity curve. So we're on the cautious side. The S&P 500, of course, had a little bit of a rebound yesterday where we didn't participate because we were flat
Why were
at,
we
at
flat
zero.
yesterday?
Yeah, exactly. That's well. Here's the invested percentage. So when you don't have any money in the market, it's gonna be zero. So but look, that's if we had gotten another leg down, which as you saw in a lot of these cases, the day two sometimes gets worse. So yeah, there's nothing wrong with waiting an extra day to see how things pan out. And again, in this case, we waited one more day for these upside reversals to kind of materialize. Um, you could also see that our portfolio ATR, even before this happened, um, Mike, you were doing a lot of kind of, and we tried to communicate this through our alerts. We were doing a lot of selling at times just to get our portfolio ATR down. And again, the portfolio ATR, we've done a podcast on this together, Mike and I. So you can take a look at the Investing with IBD podcast to go over that. But the idea is if you take the average ATR percentage for your stocks, and you basically multiply for each stock what the weight is in your portfolio, you can come up with a portfolio ATR. How much are you kind of sticking your neck out? And you can see that, look, in September we were certainly sticking our neck out, but we had come in quite a bit by how do we do that? Well, more ETFs, which have lower ATRs, that'll help. You can do it through a cash position. So you can see that, hey, here we are at a very low portfolio ATR because we have 50% in cash right now. So that's another way to kind of get your portfolio ATR down. Or just, stick with lower ATR, lower ATR positions or lighter position sizes. So there's a number of ways to kind of make that happen. Once we get up above four, we're usually pushing it. Three, I would say, I don't know. What do you think, Mike? Between two, three is kind of the norm. Three,
Yeah, like
four or
even
higher
up
is
to
pushing.
yeah, once we start coming in at 4, I'm nervous
Right.
because everything has to be going perfectly when you're at 4, or you can have a big drawdown. Now, if you don't care about big drawdowns, then you probably don't even do a portfolio ATR. But for this product, for this style, I'm trying to hammer in, pay attention to the drawdowns. It's about risk management. It would be a lot easier for us to just put a list out, and some services do that, and there's nothing wrong with it, of just saying, okay, buy this stock if it goes through this level and sell it if it goes through, your stop loss. That would be a lot easier, but we're not doing it that way.
And the
What
best
we're
thing about that is you can say, "Oh, look at all these stocks that we nailed," and then you can just cherry pick.
Exactly, and a lot of folks do that, and some with very good intentions, some with not. But what we do, we're trying to teach a method, a specific style of swing trading. Not the only style, and not the only style I do, but a style that is really risk averse. So a lot of times people will see all this action, go, "Oh my God, what are the guys doing? They've sent me like 20 alerts today. They're crazy." No, what we're trying to do is manage risk. And it's all about managing risk and managing our drawdowns. And so, yeah, why don't you explain to them what they're looking at?
So this is something that we've shown before on um, how we've been managing our drawdowns, and actually this is kind of interesting that this is basically how much we're off of our high, starting at the beginning of the year. And you can see that when all of this tariff stuff was going on and the S&P 500, this is, by the way, closing prices. Intraday, the S&P 500 was down even more off of its high. But closing price, it was down 19% off of its high, whereas we had kind of chopped that off by going to cash. We had kind of chopped that off to just 4% off our high. And we're actually almost at our worst drawdown right
No.
now. We're down there. This is about as bad as it got for us, because you can see that we were already not quite at our highs. We had come down a little bit from our highs, and so Friday really hurt in that regard. But I think one of the concerns that Mike brought up is that a lot of people, this is just very foreign, looking at it, and it doesn't tell both sides of the story. It tells how you're managing your risk, which is a huge part of what we're doing, but it's also, we want to make sure that people are seeing this part too, right? The return part. So we played around a little bit, and we'll probably fine tune this. But here's another chart to kind of give a risk versus reward. So in this case, I'm taking the year to date gain, and so of course, we start at zero, um, and what your max drawdown is. So look, when we had that 4% drawdown in here, that's I basically turned it into a positive, and that's the denominator. So but that 4% sticks with us unless we go even further down, and that's what was going on here with the S&P 500. It was getting down to 20%, and so now S&P 500 has this large denominator, that max drawdown that it's had for the year, and when you have that large max drawdown, it's a little bit tougher to get this line up, right? You really have to do very well on your return side for the year in order to make progress here. But because we have been really managing our drawdown, that risk over reward, I'm sorry, reward over risk ratio is really pretty stellar right now, because we've gotten a lot of gains and we've really managed our risk. And so this is something that we're going to toy with, maybe showing a little bit better that relationship, and how important it is for us to again make sure that we're not taking big drawdowns on our equity curve. And again, it's two sides, right? You can't be so conservative and so worried about your drawdown that you're not participating on the gains. I mean, we could have a product that has no drawdown and it's just in cash the whole time, but nobody wants that. So again, it's that relationship that we're
They
always
would in
going for.
1973 to 74, 2000
Right.
to 2002, or oh 07, oh 09, or, but
Hey,
yeah,
there are times, right? And
yeah.
what you would see in that case is you would see a situation where the year-to-date return is low, and the drawdown is also. I'll have to think a little bit about that to make sure that it gets significantly punished when that's the case. But anything to add on that, Mike?
Yeah, let's go. Well, let's stay here for 1 second. So we were just trying to. It can be very frustrating from our standpoint because we're really trying to manage risk so much, and I know that there is often pushback of the activity level or the times where we go to cash, or that people not understanding what we're after, and that's what we wanted, a picture of this. And I think you're right, this is a first draft of it, of
Mhm.
what we're trying to do. Each year is not going to be this good. This is stellar, like having this type of return with this type of drawdown. I've done so many back tests, I've traded for a long time. This just does not happen. And the fact that we don't have like a million people just saying like take the service is just baffling to me. But I do know that there's that disconnect. There's this education part, and that's why we do this every month. And we want to find other ways of educating people. But let's go back up to the drawdown thing, because I do want to just let folks know we're probably going to have a bigger max drawdown, because right now,
Yeah.
we were in cash. We went back in 50%. In fact, I was looking for more stuff to put on before that news hit, and I just frankly ran out of time because I was trying to be very picky, because we're already at 50% from zero, and so I didn't want to just slap anything on. Um, but we're risking now another leg lower, because we kind of have to. It's either that or we just go to cash for the rest of the year and just call it a year. It would be a good year. But that's not what the product is. We need to play, but we're not going to overstay our welcome. But I wouldn't be surprised come next month for us to have seen a bigger drawdown. I don't want it, but you have to risk something. You have to be willing to risk something, and that's also why we were going with those the stocks that if we get stopped out of everything tomorrow, then that is the feedback from the market telling you, hey, the stove is hot, stay back out. But yeah, I think that's it, unless we wanted to go on for 15 hours and everyone's probably already asleep.
Well, one more thing to kind of share, and
Sure.
again, some people were asking about the numbers behind that. So, right now, as you can see, we're just above 25% for our year-to-date number. 25 as of the close today, I think we're at 25.58% for the S&P 500. That is just under 13%, so 12.97%. If you want to compare that versus the Nasdaq, because Tim, my good friend Tim in the comments always wants us to make sure that we're putting the Nasdaq in that context. That's 16.63% for the year. So we're beating both the S&P 500 and the Nasdaq, fairly handily this year. One more thing to just kind of that we usually do show, and gosh, man, I was trying to get this color changed and it just wouldn't cooperate with me. We've got, again, a few half positions in some stocks. We've got some ETFs here, but we are still mostly in cash. So again, we've kind of trickled in a little bit, but we're not overly invested. So we can, if we need to, we can back out pretty quickly. Um,
I
let's
did.
see.
I did want
Oh,
to
go
say
ahead.
one thing, Justin, because I always like to give credit on things. The last chart that we did, it got that idea from this book that we both read, um, "The Way of the Turtle,"
I'll have to
and
reread it because it's been over a decade since I've read it.
yeah, and this is I actually dropped this in the pool in Vegas once. It's a great book, and it's by Curtis Faith. And so, if you don't know about the turtles and all of that stuff, it's really fun stories. But it was the way that they measured risk. They were doing a compounded annual growth rate over the max drawdowns. But we just did a quick and dirty with this one, and so that's where we got the idea. It wasn't something original.
Mhm. And I am looking through some of the questions. Again, there's always such a great conversation going on with our folks on YouTube. So yeah, some people were talking about how they remember how frustrating December was, and yeah, not wanting to necessarily go through that again. And look, we have no crystal ball. We can't say for sure that that's what's going to happen. This sideways action. We showed some examples where it comes right back to highs. Gets a little choppy still after that. A lot of this is going to be news related, but we've at least got some base case scenarios that we can look at. We know what normally happens. We know what the edge cases are. Sometimes it, kind of shakes it off right back to new highs. Sometimes it gets a heck of a lot worse. So we know that is a possibility as well. So I think a lot of it is about having kind of that knowledge of what typically happens, what your edge cases are, and that way um, when what signals are kind of telling you, oh, we're leaning a little bit more this way versus this way, and that just kind of gives you a little extra information, hopefully a little extra edge. But at the end of the day, risk management. uh, we really try and drum that home a lot. If you haven't noticed, that's going to be very key and very high on top of our priorities right now.
I did want to just add a couple things. Back in December, after the December 18th, you did something similar for me as far as slicing the data to find a bunch of potential precedents, and we did that one back where the day in question was both either a two standard deviation or a two ATR move or a three ATR move. And I did a podcast, a non-IBD podcast on that, and it went through a bunch of those examples. I reposted that on Twitter this weekend, or X. My handle is mwebster1971. I would look and watch that video. because I go through all of those examples. It's really worth studying because that setup was very similar. We just sliced the data this time a little
Mhm.
bit differently, but it's the same basic thing. And those really broader, if you look at them, it'll tell you that, you know what, what's typically happens is you get a character change after a bad break like that. Just think you're moving along, you've got this nice momentum, and then something shakes that momentum. And so when you start back up, it's going to be different, kind of a different angle of ascent. And we talked, the two of us talked on Friday about how the regression lines that we were using on Nasdaq and S&P were pretty much broken, but the IWM is, which I have a position in, is, still intact. But they were using different dates, and so it's that same basic feel when you get those real hits out of the blue, things change. And I think what happened over the weekend with all the crypto thing and the bloodbath that was over there, I think that has changed the dynamics a bit in the market because people now remember how hot the stove was. Now, you didn't see that yesterday in the market
Mhm.
because all the high octane names were going crazy. But I think it was, you heard so many horror stories about how much money that was lost. And if that's what, if you're watching and that was one of you, I just sincerely feel really bad for you because I heard some really bad stories about people losing so much with that. So just be careful no matter what investment you're doing, whether it's crypto or stocks or futures or anything else. Just try to dial back the leverage if you can.
Mhm. You know what? One thing let's do a bonus for everyone that kind of stuck with us for so long here. One of the areas that we've been keeping an eye on is XBI. This came up above its 200-day moving average line back in August. Biotechs, have been really kind of doing something different than a lot of the market. So upside reversal here on XBI. I do have a position in this myself,
As do I.
but that's something to look for. XBI tends to be a little bit more spread out. So by the way, this idea came from Tim. Since I mentioned him earlier, I'm going to give him credit for this one. I saw him talking about this, as kind of a alternative to all the AI. And I agree. I think that there's something to be said for the move here. XBI is
Well,
pretty spread out among like what 2% in a lot of different positions, whereas something like an IBB is a little bit more concentrated in some specific stocks. So, um,
yeah. So
but we
going
went with
back to the
XBI.
yeah, going back to the XBI. So this was, I totally mishandled it. I think we had it on before. I meant to put it on before. And was shaken
We
out of
did,
it.
and we got shaken out.
Yeah, and
Yeah.
I just been kicking myself. There are two positions that have really bothered me of me mishandling, and that was gold. Thank you. You knew.
Yes, I
Um,
knew where that was going. Uh,
Gold and XBI, and I told myself if the next time they give an entry, I'm going to give them a shot, both on SwingTrader and personally. So this was as close to a shot as we were going to get. It could still come into the 21 day, which means we'll have to exit and then reload. But if it sets back up, but you sometimes your strongest things won't go back down and won't give you that entry point that everyone's wanting, the real pullback, and they just keep going and going and going. So this was the closest where we had an exit signal because at the time it was a really nice upside reversal. Now it's just a so-so upside reversal. Just the difference in color it just makes a big difference to me. Like if it was up 0.14% more, I like it a lot better.
right.
But when it's pink, it
Just
just won't.
turn blue.
Yes. And the after hours isn't even getting us there. But this is a space that I think looks good because lots of the screens, and you and I have been talking about on the SMTs, lots of stocks are making it through um, our screens that look solid. It looked like they want to go a lot higher. Individual biotechs, but most of them don't have earnings or they're really speculative. So this is a nice way to play the space. I was looking at XLV earlier today and was going to put that on, and then I went through all the top holdings there, and I said, nah, this just doesn't. This might go higher. but it's not in the spirit of what swing trader is. And so we try to be very cognizant of that. And XBI made a lot more sense, and
Mhm.
we'll see how it plays out.
Yeah.
Oh, what one thing to keep in mind, and I did want to tell folks, and was my plan to tell folks today, because I thought we were going to still be in cash, that when we go back in the market, to really pay attention to what size positions we're putting on. So if we get chopped up again here, which is highly possible, and have to back out and go back to cash. When we go back in, just to manage our drawdowns, we'll probably go in with quarter positions for individual stocks and half for starting for ETFs. We're still doing the full position starting, which is a 10% position for ETFs, and a half, 5% for individual stocks. But if we do take a notch lower with off our highs, we'll have to revert and get smaller. And that's something that I learned from Marty Schwartz in his Pitbull book. He's one of the market wizards, one of my favorites, very colorful person. There's lots of great, or a few good podcasts out there, or things on YouTube with him talking. Marty Schwartz, Pitbull, get the book. You'll learn so much and be entertained at the same time. And so the message that he had is, when you're doing well or doing poorly or in a drawdown, just get smaller and smaller and smaller. He's not the only
Mhm.
person who talks about that, but is the one that stuck with me. And so that's what we will do if this one doesn't work out.
Absolutely. Well, hey, that's going to wrap it up for us this month. Thank you so much for watching, everyone. And don't forget, if this looks like some content that you would like to see on a regular basis in terms of some of that guidance and everything, check out Swing Trader. You can go to investors.com/swingtrader. Check it out, get a trial, and yeah, see if it's something that. Look, sometimes it's not going to be a great environment, but there is value to knowing when to kind of sit on your hands. We're very big proponents of that. Thank you, Mike, for all your instruction, education, and analysis. And we will see you all next month. Or if you'd like, watch us on the Stock Market Today video. Mike and I will be back doing this on Friday for the Stock Market Today to get a little bit more insights in how these precedents are playing out. See you then, everyone. Have a good one. Bye.